You are tuned in to the 5-Minute Signal, Business and Wealth. I am Vivian Thorne, economic strategist. This is not a finance podcast. This is a blueprint for building and defending your economic fortress. We don't do speculation here. We do strategy. 5 minutes on the clock, let's get to work. Yesterday, the markets stopped pretending. On March 3rd, we watched the Dow Jones Industrial Average go into a free fall, plunging 1,200 points in the opening hours as the reality of the conflict in Iran finally hit the algorithmic trading desks. While the buy-the-dip crowd scrambled to claw back some losses, leaving the Dow down roughly 400 points by the closing bell, the underlying damage was done. Brent Crude didn't just tick up, it leaped toward $84 a barrel, a nearly 5% surge in a single session. But the real story isn't the price of oil, it's the price of moving it. Over the last 24 hours, the maritime insurance market has effectively imploded. This matters because we are witnessing the birth of an invisible tax on every physical good on the planet. Major insurers like Guard and the London P&I Club have officially begun cancelling war risk coverage for the Persian Gulf. For a 100 million tanker, insurance premiums that were once a rounding error have surged to $3 million per voyage, if you can even find a provider willing to take the risk. When Maersk and other shipping titans suspend all transits through the Strait of Hormuz, they aren't just avoiding missiles, they are avoiding insolvency. The cost of logistics is no longer a variable. It is a predator eating the margins of every mid-cap company in your portfolio. The hard truth is that the stability you were promised in the 2026 outlook was a lie built on the assumption of open seas. Conventional wisdom says to wait for the volatility to settle. That is a loser's game. The reality is that we are entering a period of maritime denial. The 1,200-point drop yesterday was a warning shot, not a bottom. If you are holding companies with overextended ocean-dependent supply chains, you are holding a ticking time bomb. The market is rotating out of speculative tech and into value fortresses because in a shooting war, a software update won't move a barrel of oil or a crate of semiconductors. To navigate this today, you must execute the following. 1. Liquidity audit. Immediately identify any mid-cap holdings in your portfolio that rely on just-in-time maritime logistics. If their margins cannot absorb a 300% increase in freight insurance, they are no longer assets. They are liabilities. Exit those positions before the next leg down. 2. Sector rotation to domestic producers. Shift capital into US-based energy and defense firms that are insulated from the Hormuz choke point. Look for onshore beneficiaries, companies that control their own supply chains within the domestic borders or have long-term fixed-price logistics contracts that predate this week's insurance surge. 3. Volatility arbitrage. Stop trying to catch the falling knife of the Dow. Instead, look for opportunities in essential retailers like Target, which showed resilience yesterday by gaining nearly 7% despite the carnage. These are the companies that can pass the invisible tax of shipping costs directly to the consumer because their products are non-negotiable. Position yourself for the reality of the blockade, not the hope of a ceasefire. I'm Vivian Thorne. This has been the 5-Minute Signal. Stay sharp. This program is for informational and educational purposes only. Economic strategist Vivian Thorne is not a licensed financial advisor. This content is not a substitute for professional financial, investment, or legal advice. Always consult with a qualified professional before making any financial decisions.